This is an uncovered Japan company research report on Fullcast Holdings, ticker 4848. Fullcast is Japan's listed leader in short-term license staffing. It operates behind the spot work apps, taking on the employment, compliance, and operational responsibility that a client may not want to carry. The central question is whether that responsibility creates a durable moat as faster asset-light matching platforms grow. At the report's 9 June 2026 reference price of 1,544 yen, Fullcast traded on about 10.6 times forward earnings, with a dividend yield above 4%. Fiscal 2025 revenue was 77.2 billion yen, and operating margin was 10.3%. The valuation is not a simple bargain label. It reflects two issues investors need to test: whether the margin can recover and whether gig platforms can move into Fullcast's higher responsibility niche. The product is more than a list of people available for a shift. A logistics operator, retailer, event organizer, or food service client can use Fullcast's licensed dispatch model. Fullcast becomes the employer of record, handling worker registration, contracting, payroll, social insurance, workers' compensation, compliance, and on-site support. Gig apps can match a worker to a client, but usually leave those responsibilities with the client under a business consignment contract. Fullcast's four segments are not equal. Short-term work support produced 61.1 billion yen of fiscal 2025 sales, or 79% of the group, at a 13.9% operating margin. It generated an estimated 85 to 90% of group operating profit. Food service, sales outsourcing, and security and other operations broaden the business, but are smaller or lower margin works in progress. The investment case rests primarily on the core staffing operation. Fullcast's moat lies in risk absorption. A dispatch license, labor law compliance infrastructure, and decades of corporate relationships are not reproduced by a consumer app overnight. The company runs the whole service chain, from worker acquisition and vetting through payroll and billing. The trade-off is lower margins and more operational intensity. It is also genuinely weaker at the one-stage apps have industrialized: fast matching and consumer user experience. Over 5 years, revenue rose from 52.4 billion yen to 77.2 billion yen, a 10.2% compound annual growth rate. Yet operating profit moved only from 7.6 billion yen to 7.9 billion, and the operating margin fell from 14.5% to 10.3%. Strategic advertising, goodwill amortization from acquisitions, integration costs, and a mix shift toward lower margin segments explain the compression. Fiscal 2025 offers a useful distinction. Revenue rose 12.6% and operating profit recovered 10.9%, while net income fell 12.9%. The divergence reflected a 1.295 billion yen gain on the previous year's sale of subsidiary BOD that did not recur. For Fullcast, operating profit and cash flow are more informative than a single year's net income, which can be affected by disposal gains and tax timing. Fiscal 2025 was an M&A acceleration year. Goodwill reached 8 billion yen, and interest-bearing debt rose to 12.2 billion yen from a largely net cash position. The equity ratio declined to 53%, and the debt-to-equity ratio rose to 39.9%. These are still manageable figures against management's 1x debt-to-equity ceiling, but they make integration quality, cash conversion, and capital discipline essential to watch. Management's FY 2029 plan targets 12.5 billion yen of operating profit, 1.6 times fiscal 2025. Its four pillars are brand investment, group synergy, digital transformation, and continued acquisitions. The practical test comes down to two unproven levers. First, can advertising build durable worker market share rather than remain a margin drag? Second, can acquisitions create synergy without permanent dilution from goodwill and integration cost? The report places Fullcast near 9.9 times trailing and 10.6 times forward earnings, toward the lower end of a 5-year 7 to 24 times range, and below an approximate 15 times peer sector average. A discount can be rational. Investors are weighing platform disruption, margin erosion, integration risk, and governance concentration. The constructive case is that a durable license niche, a recovery in margins, and plan execution could narrow that discount. The research's author-defined 3-year scenarios span 910 yen in the bear case, 2,266 yen in the base case, and 3,668 yen in the bull case. These are stated assumptions, not price targets or recommendations. The most useful indicators to watch are operating margin moving back above 12%, return on equity improving toward the 20% plan target, debt staying inside the cap, entry integration, and any credible move by Timey or other platforms into licensed B2B staffing. Fullcast is a niche-leading licensed spot work staffer in a structurally growing labor market. Its compliance and relationship moat is real, but it comes with lower margins and a competitive gap in consumer matching. The valuation discounts that tension. The scorecard is concise. Watch operating margin recovery, the payback on worker acquisition spending, M&A integration, and whether gig platforms can truly enter licensed B2B staffing. This has been an Uncovered Japan research report for education only and not investment advice. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.